introduction of these two gentlemen, so I'll maybe let them introduce themselves. Most people know who you are, but tell us a little bit about yourself and your firms. Let's start with Connor.
All right. My name is Connor Haley. I'm the founder and CIO at Alta Capital, a long-short equity-focused hedge fund in Fort Worth, Texas. We were founded in April of 2018. We focus mainly in sort of the micro to mid, I'd say, categories of the market. Do a lot of different things. So from buy and hold to activism to everything in between, a little bit in credit. We've expanded the scope of how we attack the space over time, but at the core, it's deep fundamental due diligence, trying to rip apart a company, understand its future prospects, and pay a fair price for it.
Brian Bears, the founder of Bears Capital Management, cleverly named Bears Capital Management. We are 23 years old. We manage about $3 billion across two strategies, concentrated small micro and mid-large cap. The two differentiators for our firm are the level of concentration, which when I founded the firm was certainly an outlier. It's certainly more common today, and the largely qualitative approach to vetting ideas and implementing them in our concentrated portfolios.
So, Brian, I'm curious, you've been investing now for 20 plus years in small and micro. I'm curious how things have changed, over the last 20 years. And it's a very open-ended question, meant to be that way.
Yeah. So I think there's a couple of quantitative things I'd say, which is I started in the business in the mid-90s. At the time, the Wilshire 5000, which is probably the broadest measure of U.S. market cap, had 7,500 companies. When I started the company, when I started Bears Capital. And today that number has basically been cut in half. And so give or take a couple hundred companies. Most of those, the companies that have left the playing field have been largely the result of M&A with an increased institutional focus on private equity and takeouts. The sort of regulatory regime introduction, Dodd-Frank, that sort of thing, made it more difficult for companies to stay public financially. So a lot of them left the playing field. And then venture capital obviously is holding companies privately much longer. And so what seems like a shrinking playing field largely from the bottom up would, an outside investor might say, well, that's, certainly reduced your opportunity set. But that's actually not really true if you sort of go through to the practical. In 2000, when I started, there were probably 2,000-ish companies that were truly on limits for us. And those 2,000 included a lot of names that, from a qualitative standpoint, wouldn't meet our most basic criteria. And so we probably had 1,200 or so companies that were really investable. That number, that 1,200 number, is about the same today. So it's kind of interesting that despite the shrinking of the investment universe in the U.S., there really hasn't practically been much difference in terms of the number of opportunities that we look at. The one last thing I'll say here is that the way you kind of define microcap, and everybody has a different way of doing this. When I started the company, we looked at the Center for Research and Securities Prices, which I think has the best database of public companies going back to 1926. And the top of the 9th decile, which is the 9th and 10th decile being the bottom 20% of the U.S. market by market cap. The top of the 9th decile was about 175 million in market cap. Today, that number, I haven't checked it in a little while, but it's probably 500 or 600 million. And so the market cap of the universe that we're looking at has actually grown a little bit. And so it's, I suppose, been a bit more accommodating for us who want to be, have a growing strategy and stay sized flexibly for the opportunity set, capping assets, so forth. But we're looking at slightly bigger companies than we did when we started.
And Connor, anything to add to that? I mean, you've been investing in microcaps probably for about 10 years now, since you were in college.
Yeah, that's right. Brian hit on a lot of great points, but I think, for us, we are a global strategy. So we are looking all over the world. So while we're very aware of, fewer companies in the U.S. than before, we've done a lot in places like Sweden, Australia, Japan has a shockingly high number of, small cap companies. We'll go anywhere. And some of the trends elsewhere, as I think Ian alluded to earlier in his comments, are a little bit different. So that's been interesting. So things that have changed, I think, become more global. And then finally, kind of two kind of crosswinds. The first is, Small caps, certainly recently, it's not shocked anyone, have materially in aggregate underperformed. And the small cap indices, unlike, say, the large cap indices, right? Small cap's very successful. It may graduate out of the index, or it may get acquired by PE or et cetera. In large cap land, the largest players get bigger. They become a bigger weight of the index. Now, there are scenarios, believe it or not, where that could reverse, and that could lead to underperformance from an index, but we really haven't seen it. So that's one thing is I think small caps, micro caps have become even more neglected because of that dynamic. But then the sort of other crosswind is there's been this evolution of really hyper-focused niche communities. MicroCap Club being a phenomenal example. But there's also Substacks. There's these communities that have popped up that are more focused than ever on this unique niche within investing. And I think how you leverage that, how that factors into your process, how you think about your network is important, at least from my perspective, in terms of outperformance over the next 10 years.
I'd add one more thing here, which is the constitution of the companies that we look at has evolved over a quarter century. And when I started, there was no SaaS. Right, there were no SaaS model software companies, and now that's a really interesting and qualitatively exceptional business model for a lot of companies. And so the evolution of the constituents of the index itself make the game exciting for us and for me, and it's what I love about being in the space.
So maybe I'll start with Connor. In a world where great due diligence is sort of table stakes and the flow of information is so open, what sets a great investor apart from an average investor?
Sure. Great due diligence, table stakes. I'd start by challenging a little bit the premise of the question, if I can. Yes, information is freely available, but how many investors are actually reading all of the filings, are building a detailed model, are meeting with the management team, are speaking with competitors, are trying to understand sort of the suppliers? What percentage of fundamental investors are actually doing that? I think a shockingly low percentage. I think there's a lot of people, very smart people, that for a variety of reasons take shortcuts and in doing so divorce themselves from some of the insights that someone going through a full process who's really disciplined may discover. Now, that being said, how does one analyst differentiate themselves from another analyst who is actually going through all the steps? I think there's a few different ways. I think one is you have to find your own style. There are different ways to outperform. There's different ways to put up good returns. I think my style is probably a little different than Brian's. There's many examples of ways that investors have crafted how they do things. For us, and AltaFox specifically, velocity of ideas is very important. Now, we run a fairly concentrated portfolio, but we turn over a lot of rocks. And so, on a 3-person research team today, we speak to approximately probably high teens number of companies per week. Okay, that's a lot of calls. It takes a lot of effort, and that's a KPI that we track every single week, and people are accountable for. It's not because now we only invest in that many companies at any given time, and we'd like to hold our winners for a long time. But I think you have to turn over a lot of rocks. I believe in Peter Lynch. The person who turns over the most rocks is most likely to win the game. You have to turn over a lot of rocks. But if you turn over a lot of rocks, you have to have a systematic process for synthesizing that information. So we can get into this as deep as you'd want in this conversation, but if you're trying to keep it all in your head, I think that's a really bad process. For us, our best idea this year might be an idea that was a pass 24 months ago. Right? And so how did you synthesize that information? How did you make sure you got an alert that it's now interesting? And how do you do that with a team that's growing and so that the communication flow is consistent? I think you have to have a really systematic process to compare the sort of relative merit of risk reward across different ideas and have really crisp discussions so you can get to sort of the truth of the matter. So I'd say do the work. That'll differentiate you significantly, shockingly, from a large percentage of sort of the investing world. And then number 2 is try to have a really systematic process that you iterate on that's sort of true to who you are, how you want to invest, so you can compare relative investment merit across a very high velocity of ideas.
I think all that was great, and I would agree with basically all of it. I would say that there's, if you think about the three sources of investment edge, you have informational, analytical, behavioral. A client, a prospective client, an institutional client, a family office or somebody is going to want you as an investment manager to articulate a repeatable investment edge. And so within those three buckets, you have to figure out where your edge is and the repeatability of that edge and try and structure your day, your week, your firm, your life around the repeatability of that structure. And I believe that the best investment managers have some advantage in one of those three buckets, have a way of continually exploiting them over time, but most importantly, structure their firm around that advantage. And if you have hot money that's walking in and out the door every 6 months, and you're a long-term patient investor and exploiting some sort of a time horizon advantage or something like that, that's a structural firm mismatch that will likely sink the firm. And so in my experience, it's been incredibly important for us to have long-term patient-client relationships that self-select into our philosophy and process, where we articulate, and just to go a little bit deeper, we're mostly in that analytical bucket, I think. Occasionally we'll, I think, exploit a behavioral advantage. I think even in MicroCap, where I think this is a huge misconception, most people think it's just riddled with, traditional informational inefficiency, and that's the source of exploitation. But in my experience, the market is reasonably efficient across all market caps. And so we're, even with the qualitative due diligence that we do, a lot of field work, 10 analysts out in the field with a company credit card, meeting companies, customers, competitors, et cetera. It's very rare that somebody's coming back to the office that with a true informational inefficiency. It's mostly about taking what's out there, analyzing it in hopefully a unique way, leaning on a patient client base as an advantage to allow an investment thesis to work over an extended period of time. I was really struck by the Expel stock price chart, where it really went nowhere for 10 years and then finally hockey sticked up. And you ask yourself, how many of your clients would be patient enough throughout that journey to suffer through a sideways stock price, through the 3M, difficulties and patent issues and things like that. And there's always something happening with this company. And you say, the client might say to you, well, you just don't know what you're doing. This thing has gone nowhere. And then, you wake up 5 years later and it's, the sort of return that some lucky people in this room have experienced. And so you have to have the right types of clients to allow for the evolution of the underlying investment theses to out in stock price. And to get those clients, you need to be able to articulate a repeatable investment edge. So.
Now, what I find is interesting is both of you are now scaling or have scaled an organization, a research process. You were once a single PM making the decisions, doing all the work yourself. Connor, you mentioned kind of going from 1 to 2 to 3 to 4 analysts. How's your research process kind of evolved?
So I tend to talk about 4 different buckets of successful investing. That's how we think about it. So I think you have to have a really great search process. Like, how do you look for potentially interesting ideas? How do you generate hypotheses? That you have to have sort of an evaluation/valuation process, right? How do you price them? How do you value them? How do you think, which obviously incorporates qualitative, quantitative analysis, et cetera. How do you size them, right? It could be 0, they're not in the book, or it could be a very material position. How do you size them over time? And then finally, how do you monitor that thesis? How do you change the sizing? How do you evaluate the health? So those are kind of the 4 different buckets. To get directly to your question, as I've added analysts to the team, they have added the most leverage in sort of the initial evaluation and valuation, as well as the monitoring. So we have a fairly quantitative sizing process that is part of our systematic process of investing to evaluate relative investment merit. It incorporates all of our qualitative ideas, it incorporates our views of management, conviction, et cetera, but it's a way to synthesize hundreds of stocks that we've looked at since inception into a sort of single truth, which we can then debate vigorously in investment meetings. But the search process I still primarily own, but I can only speak to one management team at a time, right? I can only do one channel check call at a time. And so I'm able to get leverage through very hardworking, very intelligent analysts who have been trained in my process, who understand how we're trying to do things for sort of that first cut, so that we can talk to 20 companies in a week. I can't do that on my own.
For me, it's really been a journey of evolving myself personally, because when I started the company in 2000, I was balancing account statements and putting in trades myself and doing all of the research and trying to squeeze in meetings with prospects along the way. And so I've tried to sort of evolve my life, my professional life over 23 years to do the things that I think are very high on the value stack and to do the things that I enjoy. And first and foremost, it's managing the research process. I love, hearing about a new company that an analyst has brought back and is doing a presentation on internally. And then, speaking to clients and prospects and articulating what's happening within the firm has to be coming basically from the people that have their hands on the tiller of the portfolio. And so, my day is largely split between those two activities, and have offloaded all of the, signing of office leases and picking healthcare and things of that nature to, a competent and talented compliance and operations team. It was admittedly very difficult for me over time to sort of loosen the reins of idea generation and portfolio management and these sorts of things, where getting recommendations from, the bottom up as I got, more comfortable with trusting the people that had come up through our firm and their training and their judgment, and sort of, hearing about stories rather than living them firsthand. So that has been an evolution for me, but I think a necessary one if you want to, if you want to be a one-person shop and pick stocks and you're doing everything. I understand, embrace, and live that life, but I thought for my own sanity at some point I need to transition into more of a robust firm structure that can outlive me. And when you have employees and they have mortgages and children, and they're relying on the things that are happening within the firm for a job, you start to get really you start to feel a more intense set of pressures than just the fiduciary aspect of managing other people's money. And my compensatory mechanism, I think, was trying to evolve my own skill set to rely on other people to allow them to grow, to introduce, for example, our launch into mid-large in 2014, and do some of those things where I thought I could still marry the objective of client compounding in capacity limited way and concentrated portfolios and these sorts of things, while still allowing the firm to grow and to provide opportunity for the people that have helped make me successful.
Brian, you've always had a pretty interesting recruitment program, kind of a 3-year, and I don't know if that's changed over the last few years, but at least I did find it interesting, if that's what you still do. I was wondering if you could speak a little bit to the recruitment engine, because I think that's key to growing a firm too, is making sure you always have top tier talent.
Sure. So we try to recruit from a lot of the places you might expect, and we're typically pretty successful in that because a junior analyst at our firm will get the company credit card and be encouraged to just sort of live on the road for 3 years. And so it's an actual 3-year program. We recently, through COVID, have extended it to 4, and we may make that permanent. We're still toying with it, but it's been an iteration over the past couple of decades. But the idea behind it is, with a capacity limited, concentrated set of strategies where we would and have given money back to investors after periods of success to sort of stay sized appropriately for the opportunity set. That's real economics coming out of our pocket. We're a flat asset-based fee firm, and so we don't have the P&L to support an upward path for everybody in the organization and have everybody make partners, so to speak. And so rather than have these uncomfortable conversations about, hey, you've been a great contributor after 3 or 4 years, but there's sort of no room at the inn, and we've got to adjust the expense structure of the firm, and you've got to leave. We're just sort of upfront about that with people. And so now we recruit and we say, you got 3 years at Bears Capital. You're going to have a great experience learning everything you want to know about, small companies, and you're going to chase down all this qualitative information, and it's going to be super fun, and you're going to contribute. But after 3 years, you've got to go to business school, or you got to go start your own fund, or you've got to go work for somebody else. And so people have done all of those things, by the way. And it's a sad conversation, but at least it's upfront and we're adult about it from the start. And so it sort of inherently resets the compensation that we're paying these people every 3 years, which is sort of easier on the P&L, I suppose, and a little bit more predictable.
Same question to you, Connor.
Well, I've been taking notes on Brian because we've been thinking about what we actually have launched a similar program. So I'll be picking his brain on it. He's done it, I think he told me before, 16 years now. So it's very impressive. Look, we're a team, I guess, including myself, we're a team of 7 today. That's both research and operations. So going from 1 to 7 is a lot. And I've certainly learned a lot about, leadership and culture of team and everything else. I'm definitely a micromanager at heart. Like, I want to review everything. I want to read every SEC filing. I want to be in every model. I've had to learn what areas it makes sense to give up because you have to at some point, and that's difficult. But I have a really talented team. I'm very thankful for. I'd say on the research side, the first hire I ever made, he joined me in January of 2020. He had interned for me. He had worked at another firm for about a year, so pretty young. And he had the drive, and I thought he had potential. And I said, it's time to hire an analyst. Why don't you come move down to Texas and join me? He had never been to Texas before. I said, okay, I'm going to force you to come spend a weekend here, make sure it won't be some rude awakening. But it's been great, and he's been with me for many years now, and he's really developed into a great analyst. But I think developing people early and training them in your processes, there's a ton of merit to that. That's why I'm so fascinated in how Brian's done it. And then, the other analyst we brought on was more sort of specialist specific. He's focused on special situations, also focused on some credit. So sort of acquiring those skill sets for the firm, I think, has been valuable. But we're still learning in this regard. Don't pretend to have all the answers. But I plan to steal some ideas from Brian.
Maybe starting with you, Brian, I'm curious how a new position gets into the portfolio. I mean, you're talking about, portfolios of 10 to 15 or 10 stocks. How does one actually get in, and how rare is that? And when you do that, is one getting booted out, or is it one just strictly getting added?
So our turnover has run between 20 and 30% a year historically for the firm. So if you think about it, there's a couple new positions in a 10 stock portfolio. It's usually not 10, it's usually a little bit more. We in small micro have kind of merged the two strategies, and so it's more like 20 to 25 names now in the smaller companies. But the basic process has been, the same since inception, which is, to sort of zoom out, stock price outperformance, we believe, if you neutralize for dividends and distributions and multiple expansions and contractions, basically mimics internal compounding of business value. And I presume most people in this room would agree with that first principle. But it's often forgotten, I think, in our business. And so what we're really searching for, if you're a long-term patient investor, is internal compounding that's above average, that drives above average stock price performance. And to find internal compounding of business value that exceeds what microeconomic theory would dictate, there needs to be some qualitative aspects of the firm that would, say, prevent competition from whittling away supernormal returns, or astute management that can pull the correct levers on capital allocation or be exceptional strategic operators. And then finally, some internal or external pathway for growth for the business over time. And so those are our 3 qualitative buckets that we're looking at: moat, management, growth. And if we find something that we feel like scores very, very highly in these 3 accounts, contrasted with all of the other opportunities in the roughly 1,200 companies that we're looking at in small cap, then we present it internally, and it goes on what's called our focus list. And so our focus list is a sort of pre-qualified, qualitatively exceptional list of companies that we use to source for the portfolio. And the portfolio is essentially a conviction weighting of the names that are on the focus list. Now, note, we haven't talked about appraisal, and so the quantitative comes in at the end. So once it's pre-qualified on the focus list, then we appraise the businesses. And we do that intentionally because I noticed early in my career, lots of mistakes being made by people who look at what looks like an unwieldy set of opportunities, thousands of companies in small and micro cap. And what they'll do is they'll quantitatively screen on accounting metrics. They'll be like, if I just tasked you, and this is probably what you're doing in your life, start a microcap strategy. Well, you'd get the database of all the microcap companies in the U.S. You say, how the hell am I going to go through all of these? And so you sort of use a crutch, which is usually quantitative, and you say, well, I'm going to screen on low PE, or I'm going to screen on low price to book, or low EV/EBITDA, or something like that. My contention has been and is that will likely lead you into value traps, because the market is reasonably efficient, and companies that are trading low in relation to their earnings or book value or EBITDA are likely under earning on their capital base and in some sort of economic decline. Better, in my opinion, to structure a strategy as painstaking as it is to go from A to Z in the category, and it took us about 8 years in MicroCap to do this, and qualitatively filter every single company. And that took a really long time, and we started to fish in the ponds that we knew there were a lot of fish. Those SaaS model software companies, precision instruments, information services, where returns on capital are generally pretty strong, and we'll likely find a lot of candidates from those areas, and that is in fact what has happened. So once we've pre-qualified the best businesses run by the best people with the best runways for growth, we do that quantitative appraisal work, and then our portfolio is basically our best forward returns from our focus list. Now that portfolio conviction weighting also has a qualitative element because we understand the drawbacks of the DCF. That is, a discounted cash flow is about as, it's about as accurate as the reliability of the free cash flow of the company. So if you have a very quickly growing company, your DCF point estimate is going to be way off, when you look back on it 5 years hence. If you have a really stable set of cash flows from a very defensible business with a very static expense structure, you can be a little bit more reliant on that appraisal. But we incorporate that qualitative difference when we're constructing the portfolio, and we're much more likely to hang on to companies that exceed our intrinsic value being a long-term investor, because we know that the reliance on that point estimate is not that great.
Same question to you, Connor. You mentioned how you kind of order rank your watch list, what's in the portfolio. And I know you're pretty quantitative in that way. I'm just curious to hear more about that.
Yeah, so we are very IRR driven at AltaFox. So we care about where a stock goes. We care about the time frame it gets there. By definition, IRR. This is a bit of simplification of the process, and there are always exceptions. But the time frame we are most typically focused on is 3 years. The reason that sort of suits my investment style quite nicely is I think the next quarter is always the most competitive time frame in finance. Outside of that, it's the next 12 months. If you look at sell side estimates, everything else, like there's a lot of focus on the next quarter. There's a lot of focus on the next 12 months. Conversely, I do not think that I am particularly skilled in necessarily guessing out what it is 10 years from now. And so the 3-year time frame for us is kind of the sweet spot. And again, there are exceptions for certain businesses with exceptionally long growth runways, but 3 years, you can have a very wide variance versus, say, consensus or what the market believes. Even a medium amount of, say, top line difference with a better understanding of the cost structure, how that develops, how capital allocation develops over time. You're focused on the right questions, but you're focused on a time frame where you're not going to get it exactly right, but that's not the goal. The goal is to get it more right than sort of the market's current perception, and you can sort of measure an IRR over that period of time. So we're very kind of 3-year focused across 90% of the names we look at. And then we take a very global perspective. We do not like to bake in multiple expansion in our base case almost all of the time. And so we are also focused on sort of the underlying compounding in a business over this kind of medium-term time frame and focused on the questions that matter. Ultimately trying to get to, okay, what is free cash flow per share? What is earnings per share? Whatever we think the right way to measure sort of true business value 3 years from now is. And then we're trying to sort of quantify that across all these different companies. And now we have an IRR. Now that is not the end. You don't just take the top 15 to 20 IRRs and put them in a portfolio, because you might estimate company A has a 22% IRR on a 3-year basis in your base case, but company B has a 25%. That doesn't mean company B is better than company A. There's risk associated with that IRR. There's other scenarios. There's a level of conviction. There's management quality. There's catalysts. And so we factor all of those in as well. And we have software that factors all of our quantitative sort of scores of these qualitative judgments alongside our actual IRR, along with portfolio constraints, and ultimately spits out a single number, optimal position size. Right, and so down to the 10th of a basis point. So this is how our process works. Now, again, we don't take that as gospel. We're not systematically trading, right? However, we do tend to have a fairly high correlation in our portfolio of actual position size to optimal, because I think that this has been very helpful in helping us take a very high velocity approach, talking to 20 companies a week or so. You compound that over month, quarter, years. You're looking at a lot of different companies in sort of a database. How do you synthesize that to find the 15, 20 best stocks at any given point in time? So how does an idea go from start to finish? It starts with a hypothesis, which can be generated a lot of different ways. That results in sort of a scratch model. You then talk to the company, you talk to competitors, you build out an initial view of what you sort of think the underlying compounding looks like. That results in sort of an initial view of IRR. At this point, we reject vast majority of ideas. Most ideas will not meet the IRR hurdle that we're looking for, even without doing more work. We can say with a reasonable degree of confidence, you would have to, for example, bake in significant multiple expansion, which we don't want to do to get to the IRR level that we want. So it's rejected. That's not lost forever. It's captured, right? Again, it could be our best idea 18 months from now as the multiple is significantly contracted and the risk reward has changed. And then, we go to a second phase for the ideas that do sort of meet that criteria. So that's a lot deeper. Now we're talking to ex-employees, competitors, suppliers, visiting the company's headquarters, et cetera. We're really trying to figure out, is this a company that's one of the 15, 20 best companies in our judgment of risk reward in the global universe of kind of mid-cap?
And so as a follow-up to that, Connor, I believe you're starting to make some investments in some private companies as well. And how does that fit in to everything?
Yes, I would say, the founding philosophy of AltaFox was to take a very rigorous bottom-up fundamental research process and try to apply it to less competitive niches in the marketplace. We have stayed true, I believe, to that founding philosophy. What has changed is we have added different ways to attack niches, right? So we never did any credit before, now we do in a small way. We never did any private investing before, now we do. We never did any direct financings of companies, now we have. We've gotten on boards, we've been activists, et cetera. So the tools with which we've applied have changed, one of those being private investing. I love investing just as an intellectual pursuit. Like, I have a passion for it. I think it's fascinating. For me personally, I think a lot of investors start public investing, like they buy a company, maybe it's buy and hold, they learn about it, they follow it over time. That's phenomenal. I love that. The more I've learned about companies, inner workings, rip them apart, the more I've wanted to do more. I think perhaps a useful analogy is if you think about buying a house, right? Most consumers will buy a house, but they'll buy a finished house. It's developed, right? The vast majority of people. Over time, I've become very curious about the house, and I've wanted to actually be the architect, be the interior designer, right? And really build it from the foundation up. So that's meant, being on some boards, it's meant being a minority investor in private companies, buying entire private companies, et cetera. So we've done all of that. And ultimately, it's, I think, made me a better investor because I can understand more the conversation that's happening in a public boardroom. I can understand more sort of the demands and the different risk rewards for a CEO. So I've really enjoyed that. It's a smaller part of what we do, but I think it complements our public side because we see things on the private side and we say, okay, these are trading a lot cheaper than these public companies, or vice versa, right? Which is also interesting nuggets. So I think it's been helpful to our overall process.
Brian, you recently launched the BCM-focused small microcap fund, I think January 1st. Maybe can you tell us a little bit about that fund, why you launched it, kind of the structure of it and how it's unique out there, and just tell us about it.
Sure. So it's kind of awkward for me because I wrote a book over 10 years ago bashing the 40 Act fund as a distribution method, but here we are, launched one. And so, the thinking behind it is there's a number of things that reasons that we did it. For 23 years, we never had a strategy that my mom could invest in. I mean, it's like we have this institutional focus. We don't have a commingled fund, flat asset-based fee, separate account manager. And so having a 40 Act fund is just a way to commingle investor interest of anybody that wants to participate in our small microcap strategy. But the choice of a 40 Act fund itself sort of comes from this idea that we want a private partnership feel for investors that want to be a part of what we're doing, but we don't want subdocs and accreditation and this and that and the other thing. And so anybody with $10,000 or more can go on the website and open up an account directly. What we don't want is the traditional warehouse distribution model where, you can open your Schwab app and sort of willy-nilly buy and sell the fund and be disruptive to us and the underlying portfolio as a shareholder. And so we want long-term patient capital, as we have with all of our strategies over time. But we finally have a vehicle that's opened up and sort of candidly, like, this is where I'm putting my own money. And so I kind of wanted this alignment that where Bears Capital 2.0 is, people can come along and share a common destiny with me and my personal capital. For a whole host of compliance reasons, separate account management is very problematic for alignment of interests because I can't trade pari passu with our clients. I have to wait till the day after, so my portfolio looks different from our clients, and all this sort of stuff is happening. And we were asked to launch a 40 Act fund, similar one to the one we launched on January 1st for a large private bank, and it's gone really well. And I sort of like the structure. And so I recruited Will Thorndike, who's the author of The Outsiders, is one of the board trustees, and a guy named Sandy Leeds, who ran the UT MBA fund for a number of years very successfully, who's kind of a local legend in Texas. And so the three of us are the board trustees of the fund. So it's BCSMX is the ticker, and you can track what we're buying and selling. So
Maybe one last question for you, Connor, and then I'll open it up to the audience. You mentioned activism. You've dealt in activism a few times over the last few years. I'm just curious, your biggest lessons learned thus far on the activist side.
How long you got? Learned a lot. It's funny. Sometimes people like to brand us as activists. We're not an activist fund. We have great relationships with the vast majority of management teams. Something we strive for. We want to be a patient, long-term partner. We want to present ideas. We want to be a really supportive shareholder. That being said, when you look at a lot of different ideas around the globe, you will find you will either find situations where the theoretical value is very significant relative to the current market price, but the practical value is far less. And the reason it's much less is because of a problematic management team and or board. So that's one. You will find those. You don't have to look too hard. Or the second thing is it could find you. You could be in a business where you invested with an original thesis and it went off track, and the management team and or board are not doing the right things for shareholders. And I do think that there is a serious corporate governance problem, particularly in this country, where board members just in general do not have enough skin in the game, do not care about shareholders, and in many cases are extremely antagonistic for their own interests despite having very little skin in the game. And that is really a problem. And so, yes, we've gotten involved in different situations. In every situation, we have tried to stick up for minority shareholders. We have a selfish interest in doing so, but I also do care about the sort of broader interest. So that has meant many different things. It's meant we have helped fire management teams. We have helped get rid of board members. We have helped fight against opportunistic bids that were far too low and actually negotiate for a higher price for shareholders. I think it's really important. It's crazy to me that activism gets a bad rap. There are some, in any field, there are going to be some people who do it the right way, the wrong way. But I think activism has never been more important for public markets because there's a real public market integrity issue, and it's because of management teams and boards that simply do not care.
Okay, questions from the audience?
This is about governance. Yeah. I do think it's a growing problem. Yes, look, the influence of passive shareholders who have bought the shares with literally zero diligence by definition is a problem, right? Because they control a growing percentage of companies around the world, right? So you look up the top holders for any security, there's a very good chance one of a few names or really all of them will show up, and they have done zero diligence on the stock. And they really don't care how it does either, right? The ultimate outcomes of those firms are not really tied to the performance of that stock. And so you create an incentive issue. And there's a lot of interesting debates you could have about how that can be solved, but I do think it starts with the shareholders who do have an incentive, who have done the work, being more vocal, being more active, and when appropriate, taking a stand against gross violations against minority shareholders.
Hi, my name is Justin Byron. Quick question, Connor. So I'm a private company CFO, so a lot of what you said resonates with me. I'm curious on your private investments. What is your interactions with management? Do you, because maybe you either have minority stake or you own them, are you talking to them more often than you would if as a public company? How do you strike that balance between enabling them but also not distracting them? And then what are some of the ways that your firm helps these companies grow under your portfolio?
Sure. I think every situation is different, right? So there's a situation where we control a majority of the board. We're by far the largest equity investor. We're very involved, right? Now we want to be supportive. And so a good example is like it's a small business. And so, they needed to, we bought a business from a founder. It's cash flow positive. It's a very good business, but they've never really had a growth strategy, right? So our team, Alta Fox, we went out, we interviewed 20 different outsourced marketing firms, right? We did all the work for them. We priced them. We we auctioned them against each other. We came back, we said, look, here's the short list. Here's 5. Here's the full list if you want to look at it, but here's the 5 we think are most relevant. One's an industry specialist. One's sort of a generalist. And then we brought the CEO on those calls. So we did the legwork for the CEO. We helped negotiate. We tried to be supportive so we can bring additional resources in a way that doesn't distract him in this case. So there's another situation where we're a minority investor. That's a little bit different dynamic. But look, I'm also on a public company board, right? I find myself often saying no, or that's not good enough. And that's not a super fun place to be in, but I think that's what a board member should do who has a lot of skin in the game is, that's too expensive. That's not where we should be allocating capital. That's not good enough. I think a lot of times in public company boards, and probably private as well, you have people who just want to get along, right? They want to go along with everybody else. Sometimes you have to be the bad guy and say no.
Hi. Seems like there's not a lot of buyers out there, institutional buyers as much, and as a result, not as much liquidity in micro and nano cap. How especially, I guess, in the past year and a half, how does that play in terms of, where do you guys find bottoms and how do you guys consider certain stocks, especially if you have a mark-to-market fund?
Well, let me start by saying I presume everybody in this room has seen the disparity in forward PEs between smaller companies and larger companies, right? And so I think the index is basically only doing well because of a handful of names, and by the index I mean the S&P 500. We had a sort of quasi 2001 moment in small caps in 2022, where that forward multiple compression really crushed anything with growth as a part of the value equation. So, obviously rates going up affecting the terminal value was, kind of a primary driver there. I don't see institutional liquidity as either the culprit then or the culprit now for what feels like a lack of bid. It is probably it's probably a reallocation of a lot of dollars into passive. It's probably a reallocation of a lot of dollars into these pod shops, the Balyasny's, 0.72s and stuff that have just sort of a different overall take. Lots of money has been, when I started in the business, there was still this sort of ongoing tectonic shift from 60-40 stocks bonds in the institutional world to what is now known as the endowment model. Well, people have been frustrated, I think, by the performance of lots of institutional long-only managers, and so they're putting money in, pod shops, long short, a lot of other things, and a wholesale shift into private equity and VC because the backward-looking returns have been good. I'm not so sure about the forward-looking returns. So I suppose that there is some credence to this idea that maybe there is, less institutional dollars chasing these names, but the daily liquidity of the names themselves sort of run counter to that. Like, we're not noticing like a drying up of liquidity per se, daily trading volumes in small and micro. If anything, it's probably a little better than when I started. I'm not sure that's a real satisfactory answer to your question, but I think it's definitely worth noting that, like the drawdown that I think people are waiting for, especially on the, what feels like a narrative of a recession coming, whether that's correct or not. I think has largely happened, at least the bulk of it in 2022. And I'm not sure if it maps to other people's experience, but certainly wasn't it was a forgettable year for us. Let's just put it that way. But yeah, I think despite that drawdown, it's not like we're having problems getting in and out of names with lots of money in illiquid stocks. On the contrary, that problem is much easier for us today than it was, say, 20 years ago.
Yeah. I have a question. Is there one segment of the market that you will never put a single cent into?
Probably anything that's directly commodity based. So we don't spend any time on gold miners or oil and gas exploration, where the entire thesis is determined by the price of the underlying commodity. We don't have a variant view there, so we spend literally zero time in those areas. Maybe there's some pick and shovel businesses that have certain qualitative exceptionalism that we might look at as a cyclical ride along, but through the cycle will do much better than the direct exposure companies. The other area is, most people don't realize, but when I started, it was, I think, 1 in 6 stocks in the microcap space was a regional bank or thrift. And today that number is a little bit less, but it's still a huge portion of the universe. It's hard to know what's on the inside of those businesses, and it's hard to get a real sense for the risk exposures that you're taking in those businesses. And even if you're right, the returns on capital are not nearly what you could get in other areas. And so we tend to not do any work in those. We never say never, but we've never owned a regional bank or thrift.
Yeah, I would say biotech for us is definitely off limits. We don't do a lot in energy or commodity-based businesses either. I would have probably said financials prior to this past year. We've found some opportunity in some sort of specialty financial companies that do have high returns are sort of the outlier to Brian's comment. But in general, I'd say I think the data would say if you are highly skeptical of just unprofitable microcaps, you'll do better. Sort of to Ryan's comment earlier about it's important to be profitable. It puts constraints on the business. I think that's a real litmus test of the business model. It's a simple statement, but the data for unprofitable microcaps is a lot worse than those that have sort of, we'll say, positive free cash flow generation. So it's unlikely that we invest in something that's, we'll say, EBITDA negative. If we do, it's because we think there's a near-term inflection to very significant profits in the near term. And if that does not materialize, our thesis is probably broken. We're probably out.
Thanks, Bill.
How do you decide when to sell a stock?
For us, we're very IRR driven, right? So if we don't change anything, like if our numbers, our assumptions haven't changed, therefore our price target hasn't changed, and the price goes up, our IRR by definition is going down, and our software will by definition be recommending a smaller optimal position size. And given we are tracking hundreds of names to try and find the best 15, 20, there's 15 to 20 names just below our portfolio that we really, really like, that are nearly as good as some of the things in our portfolio, but not quite there. And so our turnover is probably higher than what Brian mentioned, just our strategy, because we're trimming and adding on the margin, right? So just as a silly example, if we invest in something, we think it has a 23% 3-year IRR, we think it's a good business, everything else. Well, if the stock moves up and our numbers haven't, and now it's 17% estimated IRR, we may have a stock that has done the opposite. It's gone down, 15%. Our numbers haven't changed, and now our IRR is better. We might be trimming from one, adding to the other. All numbers are dynamic. We frequently add when stocks goes higher because our fundamentals have gone up even more than that. But it's a fairly quantitative process for us, and it's IRR driven.
I would add a number of things to that. This is the hardest question in portfolio management, in my view. I think it's relatively simple to understand why you would buy a stock. I think it's very, very elusive to understand the proper theoretical reasons in a dynamic portfolio why you would sell one. always remind myself by looking at long-term stock price charts like of a Home Depot or something, and it's 18% compounding for 40 years. Is anybody smart enough to pick the localized tops and bottoms along the way? The right answer is probably just to buy the damn thing and hang on to it. But then you go through periods of like 2020, 2021, 2022, where lots of names get way ahead of themselves, and you say, well, I should have sold that at 150 cents on the dollar. And you're on the backside of it, and you've seen the stock price decline. Shoulda, woulda, coulda. You hit your forehead, but I'm reminded of this Expel stock price chart again. It's like, who would have held it through that flatlining period to inflect, and then when would you have sold it on the inflection? Right, when it raced ahead of your price to intrinsic value estimate at 110 cents on the dollar, at 120 cents on the dollar, at 130 cents on the dollar, and wouldn't you feel like a fool if it becomes the next long-term compounder and continues to do so? And so this is the hardest question, I think, and most managers that I have met do some sort of mathematical rank ordering of their portfolio on price to intrinsic value, and it's sort of they tell their investors, we're going to sell the top, buy the bottom, we're going to sell our 100-cent dollars and buy our 60-cent dollars. But in my view, that actually admits of a mistake, which is the qualitative equivalence among those positions. And XYZ at 80 cents on the dollar is different than ABC at 60 cents on the dollar, and it could be very rational to buy the 80-cent dollar and not the 60-cent dollar, or to sell the 80-cent dollar based upon deteriorating fundamentals in the qualitative thesis. It could be that there's disruptive competition coming down the pike. It could be that key members of the management team have left, and so I think everything needs to be viewed through this qualitative lens. I have a pretty hardened view on that, obviously, but I think it's because every business is a little bit different. I mean, I'm sitting here listening to Ryan Pape speak, and I'm like, would I be an idiot at selling Expel at 100 cents on the dollar? Like, maybe there's something qualitatively equivalent at 50 cents on the dollar, but man, that's a pretty high hurdle to meet. And so I do feel like you need some element of qualitative judgment combined with the quantitative. The quantitative certainly is a guide, and there is a point at which, just based on the price action alone, we would get out of a position. I remember we owned a 3D printing company, and it had a similar price stock chart, and it was flat for 5 years, and everybody was like, "You're an idiot for holding this. You're totally wrong." Like, how long before you just recognize that this thesis isn't playing out? And then 6 months later, it's like this, and 3D printing's on the front page of The Economist and in the Wall Street Journal, and it was a multi-bagger for us, and we sell it because the price had raced well beyond what we could justify in our DCFs, and it was trading at 250 cents on the dollar, and so we just bought a position based on valuation alone, and then it doubles again. Of course, every investor's great story, and so it's a really, really hard. It's a really, really hard decision or it's hard to put a perfect framework around when to sell a name, and I think you have to really understand how the sausage is made in a qualitative context. So that would be my additional comments.
Hi. So I have a question for both of you, and then a question to Mr. Haley. So I know you guys started really young. I know Mr. Bears even worked for free. And Mr. Haley, I think you took 1 year off to intern for Motley Fool. I just want to ask, if you guys were to start over again as a college student, what would be the best non-cliche advice you guys would give to yourself? Sorry.
Go into private equity.
Also to Mr. Haley, I noticed Alta Fox recently hired a new head of quant, and you guys also hiring quant interns. I'm just wondering if you incorporate quant stuff to your research process, or is it only for the software for valuation, like you mentioned?
Sure. Well, great question. So on the first one, this is the same advice I give any college student who reaches out. I say, read as much as you can. Read the greats. Read Buffett. Read Greenblatt. Read all the traditional classics. Start a blog, right? Really try. Try to do it on your own. Start a blog. Follow companies. Do your best. It may be terrible, but it will improve, and you'll get feedback on it, and that's really valuable. So have thick skin and use it to get better. and just be as active as you can. If you can start a small personal account, that's great too. So really just get into it as quickly as you can, but take the research seriously. Like if you're going to write it up on your blog, if you're going to buy a position in your personal account, get on the earnings call, right? Build a model, try to understand, ask questions of IR. Like just get involved as you can, because there's no substitute for sort of being there and following the company with real capital. That's number one. The second question you asked about sort of data. I do think that I agree with Brian. Like there's so many important qualitative aspects of investing. I personally believe for how we invest that you have to have a data strategy. Now, what we don't want to do is we don't want to compete against Citadel and predicting next quarter's earnings for a large liquid name. That's a fight you're never going to win. That being said, I want to have an advantage over myself 5 years ago, sort of a man in a Bloomberg, right? In the universe of stocks we're looking at. So how can I, with the additional scale we have today, essentially outcompete the previous version of myself and give myself and my team an unfair advantage today? And we are investing. We're making long-term investments in data. We're making long-term investments in the universe of stocks that we care about, not to systematically trade, but to identify potential hypotheses and really accelerate the existing fundamental work of our research team.
I would only add one thing on your first question, or the question around what advice would you give to a college student, is that when I came out of college in 95, I did think about doing kind of a Buffett style partnership, a 6% hurdle with a 20% carry, get friends and family money, and just start my professional investing career without any experience. And I made what I view now as the correct decision to go work in industry for a number of years to get a feel for what it's like to see what other types of people are in this industry, like where I stack up candidly, what are the various strategies available to professionally manage money. And I knew I wanted to be an entrepreneur and build a business around something like that. And I felt like I would have been in a dark room trying to feel out the walls for myself if I had started that fund, and instead I was able to sort of flip on the light switch and just see everything for what it was by working in industry for a couple of years. So I think, at least for me, that was super valuable, and it allowed me to read the Swenson book and to understand the endowment model and where the opportunities might be to actually build a firm around this. And so I actually think there's a lot of value from just going and working in industry somewhere. To the earlier points about mentorship and things like that, it really does help to find the right types of people to work for and to work around. But I do think that experience was invaluable to me.